Money is a vital part of our daily lives, enabling a wide range of transactions, from buying goods to paying for services. It serves as a universal medium that simplifies trade by eliminating the need for direct barter. People prefer to receive money for their products and services because it can be exchanged for anything they desire. Consider a shoe manufacturer who wants to buy wheat. To do so, they first exchange the shoes they produce for money and then use that money to purchase wheat. Now, imagine if they had to directly swap their shoes for wheat without using money. They would need to find a wheat farmer who not only wanted to sell wheat, but also needed shoes in return. Both parties would have to agree on this specific exchange, which is known as the double coincidence of wants. In a barter system, where goods are directly exchanged, this perfect match is essential. In contrast, when a monetary system is in place, the double coincidence of wants becomes unnecessary. Money acts as an intermediary, eliminating the need for a precise match of desires between buyers and sellers. The shoe manufacturer doesn't need to search for a farmer who wants to buy shoes and also has wheat to sell. They only need to find a buyer for their shoes. Once the shoes are exchanged for money, they can use that money to buy wheat or any other item in the market. Money's role as this intermediary in the exchange process earns it the title of a medium of exchange. In essence, money streamlines our economic interactions by providing a common means of trade, making transactions more efficient and convenient for all parties involved. It serves as the bridge that connects diverse wants and needs in the marketplace, simplifying the exchange of goods and services. Please subscribe to never miss any episode. A summary for every chapter has been uploaded to the channel. It will add value to your preparations. Moving on to the next section, what are modern forms of money? In the past, various objects like grains and cattle served as money. Then came metallic coins made of gold, silver, and copper. Can you tell me why only these three elements were used to make coins? Today, we use modern forms of money, including currency, paper notes and coins, and deposits with banks. Unlike earlier money, modern currency isn't made of precious metals or everyday items like grains and cattle. It doesn't have any inherent value. So, why do people accept it as a medium of exchange? The government authorizes it. In India, the Reserve Bank of India issues currency notes on behalf of the central government. The law also makes it legal for transactions in India to be settled with rupees. No one can refuse rupee payments. People also hold money as deposits in banks. For daily expenses, they need some currency, but often they have extra cash. So they deposit it in bank accounts, where it's safe and earns interest. These deposits can be withdrawn whenever needed, making them demand deposits. They offer a special feature. Payments can be made through checks, which are paper instructions to the bank to transfer a specific amount from one person's account to another's. This makes demand deposits like money. Banks play a crucial role here. Without them, there would be no demand deposits or check payments. Modern money, including currency and deposits, is closely connected to the modern banking system. Follow the instructions in the description below to maximize your learning capabilities and speed. So, in short, modern money in India consists of currency authorized by the government and demand deposits held in banks. Both play a vital role in everyday transactions, making the exchange of goods and services more efficient. The banking system helps ensure the smooth flow of these modern forms of money in our economy. What about the loan activities of banks as lending agency? Banks play a crucial role in our economy by taking deposits from the public and utilizing them to meet the financial needs of individuals and businesses. However, they don't keep all the deposited money as cash. Instead, they retain a small portion, typically around 15% in India, as a provision to accommodate depositors who wish to withdraw funds. Since not everyone withdraws money simultaneously, the bank can manage with this cash reserve. The major part of the deposits is used by banks to provide loans for various economic activities. Banks serve as intermediaries, connecting those with surplus funds, depositors, to those who require these funds, borrowers. They charge a higher interest rate on loans than what they offer on deposits. The difference between the interest they charge borrowers and the interest they pay depositors is the primary source of income for banks. However, there are many different credit situations that banks have to deal with. Let us look at two different credit situations. They do not cover the entirety of real-life situations, but it's good as a mental exercise. So, credit, which involves borrowing money, goods, or services with a promise of future repayment, is an essential part of many of our daily transactions. We can understand how credit works through two contrasting examples. Please like the video and share it with your rivals. The more you compete, the shinier you get. Let's see the first case of the festival season. Say a shoe manufacturer receives a large order for 3,000 pairs of shoes to be delivered in a month for an upcoming festival. To meet this demand, he needs to hire more workers and purchase raw materials. He obtains credit by asking his leather supplier to provide leather up front and promises to pay later. Additionally, he gets a cash advance from a trader for 1,000 pairs of shoes, with the commitment to deliver the entire order by the end of the month. He successfully fulfills the order, earns a profit, and repays the borrowed money. In this case, credit helps him manage working capital, meet production costs, and increase his earnings, playing a positive role. Second is of a farmer. Let's say a small farmer takes a loan from a moneylender to cover cultivation expenses, hoping her harvest will enable loan repayment. Unfortunately, her crops suffer from pests, leading to crop failure. Despite her efforts, she can't repay the moneylender, and her debt grows. The next year, she takes another loan for cultivation, but her earnings can't cover the old debt. Eventually, she has to sell a part of her land to clear the debt, pushing her into a debt trap. Credit becomes a burden, not an aid. This situation is a reminder of the risks involved in credit, especially in agriculture, where factors like pests, moneylenders, and climate can play a role. These two cases highlight how credit's impact can vary significantly depending on the risks involved and whether there is a safety net in case of loss. Credit can either enhance one's financial position or, in some situations, lead to a debt trap where recovery is exceptionally difficult. Understanding these risks and having support mechanisms in place is crucial in determining the usefulness of credit. Everything ultimately comes down to the terms of credit. Every loan agreement has specific terms that both the borrower and lender agree upon. These terms include the interest rate, collateral, and repayment arrangements. Let's break down these components using a story. Mega borrowed Rs 5 lakhs from a bank at a 12% annual interest rate to buy a house. She agreed to repay the loan in 10 years through monthly installments. To secure the loan, she provided the bank with her employment records and salary details. The bank retained the house's papers as collateral, to be returned once Mega repays the entire loan with interest. First, and the most obvious, is the interest rate. It is the extra amount the borrower must pay back along with the principal amount. It's like the cost of borrowing money. For Mega, it was 12%. Next is collateral. Lenders often ask for collateral, which is an asset owned by the borrower, like land, buildings, vehicles, or deposits, that serves as a guarantee for the lender until the loan is fully repaid. If the borrower can't repay, the lender has the right to sell the collateral to recover the money. In Mega's case, her house papers are held as collateral by the bank until she pays off her loan. Yet another is documentation. Borrowers might need to provide documents to prove their ability to repay the loan. In Mega's situation, she had to show her employment records and salary before the bank approved her loan. Finally, we have the mode of repayment. This refers to how the borrower will repay the loan. It could be in monthly installments, annual payments, or other agreed-upon schedules. Mega's loan, for instance, is to be repaid in monthly installments over 10 years. These terms of credit can vary widely from one loan to another, depending on the lender, borrower, and the nature of the loan. The next section will provide examples of different credit arrangements with varying terms. Understanding these terms is crucial when taking a loan to make informed financial decisions. But there are multiple ways for credit arrangements. We shall look into these real-world examples, illustrate various credit arrangements and their impact on people's lives. Example 1. Crop loan. Shyamal, a farmer, traditionally borrowed money from the village moneylender at a high interest rate of 60% per annum. More recently, he shifted to borrowing from an agricultural trader in the village at a lower rate of 36% per annum. The trader not only provides credit for farm inputs, but also ensures that the farmers sell their crops to him. This way, the trader secures prompt repayment and benefits from buying crops at low prices after harvest and selling them at higher prices later. These examples highlight how local moneylenders and traders often serve as sources of credit for small-scale farmers, albeit at varying interest rates and terms. Example 2. Bank loan. Arun, a farmer with 7 acres of land, secures a bank loan for cultivation at an interest rate of 8.5% per annum. He plans to repay the loan after the harvest by selling part of his crop. He intends to store the remaining crop in a cold storage and apply for a fresh loan from the bank using the storage receipt as collateral. This example showcases a more formalized and structured credit arrangement offered by banks to farmers. It allows them to manage their finances more efficiently and seasonally, with the flexibility to repay the loan and store their produce. Example 3. Landowner credit. Rama, an agricultural laborer, faces financial challenges during months with no work or unexpected expenses. She depends on her employer, a medium landowner, for credit. The landowner charges a high interest rate of 5% per month. Rama often needs to take new loans before repaying the previous ones, leading to a debt cycle. Despite her employer's unfavorable terms, Rama relies on him for credit due to the lack of alternative sources. This example reflects how landless laborers often find themselves in vulnerable situations, relying on their employers for credit, even at high interest rates, leading to a cycle of debt. Please subscribe to our channel. It will add value to your life. Next is example 4, cooperative society loans. In rural areas, apart from traditional banks, cooperative societies provide a vital source of affordable credit. These cooperatives bring together members who pool their resources to support each other in various fields, such as farming, weaving, or industrial work. For instance, the Krishak Cooperative in a nearby village in Sonpur has 2,300 farmer members. They accept deposits from members, using these deposits as collateral to obtain substantial loans from banks. These funds are then loaned to members for various purposes, including buying agricultural equipment, funding cultivation, and constructing homes. Repayments facilitate a continuous cycle of lending, making cooperatives a valuable source of credit for rural communities. These examples highlight the diversity of credit arrangements in rural settings, ranging from informal and high-cost sources like moneylenders and local traders to more formal and structured bank loans. The choice of credit source often depends on the individual's financial situation and the availability of alternatives. Access to affordable credit plays a significant role in the economic well-being of individuals, and the terms of these arrangements can impact their financial stability and livelihoods. That was mostly informal ways to gain credit. What about the formal way? Are there sufficient loan availabilities via formal methods? In India, people obtain loans from a variety of sources, which can be categorized into formal and informal sector loans. Formal sector loans are provided by institutions like banks and cooperative societies, while informal sector loans come from moneylenders, traders, employers, relatives, and friends. Formal sector loans are supervised and regulated by the Reserve Bank of India, RBI. Banks, for example, are required to maintain a minimum cash balance from the deposits they receive, and the RBI ensures they follow these guidelines. Moreover, the RBI oversees that banks extend loans not only to profit-making businesses, but also to small cultivators, small-scale industries, and small borrowers. Banks regularly report details of their lending activities to the RBI, including the amount lent, the recipients, and the interest rates. In contrast, there is no overseeing body for the credit activities of informal lenders, giving them the freedom to set interest rates and employ various means to recover loans. Most informal lenders charge significantly higher interest rates than formal sources, making borrowing more expensive for individuals. This elevated cost of borrowing means a substantial portion of the borrower's income goes towards repaying the loan, leaving them with less for their own needs. But what happens if there are high borrowing costs? This can lead to various problems. For some borrowers, the interest rate could make the total repayment amount greater than their income, resulting in a cycle of increasing debt, which is often referred to as a debt trap. Additionally, potential entrepreneurs might be discouraged from starting businesses due to the expensive nature of borrowing. In light of these challenges, there is a critical need for formal sources of credit, such as banks and cooperative societies, to lend more extensively. This would lead to higher incomes for borrowers, enabling them to access affordable credit for a wide range of needs, from farming and business to setting up industries or trading goods. Affordable credit is vital for the development of the country, facilitating economic growth, job creation, and poverty reduction. It empowers individuals to invest in their future and contribute to the nation's progress. Is there a discrimination? Formal and informal credit? Who gets what? Notably, 85% of loans taken by poor urban households are from informal sources, while only 10% of loans for rich urban households come from informal channels. A similar pattern exists in rural areas, with rich households predominantly accessing affordable formal credit and poor households relying on expensive informal sources. This data reveals a few crucial insights. Firstly, the formal sector presently fulfills only around half of the credit requirements in rural areas, leaving a substantial gap filled by high-interest informal loans. To alleviate this, banks and cooperatives should enhance their lending in rural regions, thus reducing the dependence on expensive informal credit sources. Secondly, it is imperative to address the unequal distribution of formal credit. Currently, wealthier households tend to access formal loans, while the poorer segments rely on informal sources. Ensuring more equitable access to formal credit can provide the less affluent population with opportunities for cheaper loans, promoting financial inclusion, and reducing income disparities. In short, expanding and equalizing formal credit access is vital for improving the financial well-being of the marginalized and promoting economic development in both rural and urban areas. There is something called self-help groups that is empowering the poor with financial inclusion. In many rural areas, the poor still rely on informal sources of credit, primarily due to the inaccessibility of formal banking services and the stringent requirements for obtaining bank loans. One of the major obstacles is the lack of collateral, which prevents the poor from accessing bank credit. Moneylenders, despite charging exorbitant interest rates and subjecting borrowers to harassment, are often more accessible and flexible. To address this issue, innovative approaches have been introduced to provide loans to the poor, especially women. The concept involves organizing rural poor individuals into small self-help groups, SHGs, and encouraging them to pool their savings. These typically consist of 15 to 20 members, often from the same neighborhood, who regularly meet and save varying amounts, typically between 25 to 100 rupees, depending on individual saving capacity. Members can borrow small loans from the group itself, with interest rates significantly lower than what moneylenders charge. After a year or two of consistent savings, the SHGs become eligible for bank loans. Bank loans are sanctioned in the name of the group and are meant to create self-employment opportunities for members. These loans can be used for various purposes, such as releasing mortgaged land, obtaining working capital, acquiring assets, or investing in income-generating activities. Crucially, most decisions regarding savings and loan activities are made collectively by the group members. This shared responsibility includes decisions about loan purposes, amounts, interest rates, and repayment schedules. The group also collectively ensures the repayment of loans, fostering strong accountability. Due to these features, banks are willing to lend to poor women organized in SHGs, despite their lack of collateral. SHGs, therefore, effectively help borrowers overcome the collateral barrier, providing them with timely loans for diverse purposes at reasonable interest rates. Moreover, SHGs serve as building blocks for the organization of the rural poor. In addition to achieving financial self-reliance, the regular group meetings create platforms to address and take action on various social issues, including health, nutrition, and domestic violence. One remarkable example of the success of such an approach is the Grameen Bank in Bangladesh. Initiated in the 1970s as a small project, it has grown to include over 9 million members in approximately 81,600 villages across Bangladesh, primarily consisting of women from the poorest segments of society. These borrowers have demonstrated not only their reliability as borrowers, but also their ability to initiate and manage a variety of successful income-generating activities, showcasing the potential for economic empowerment through SHGs. Let us see how India is doing in affordable availability of credits across sectors in 2022 to 23. Let's begin with MSMEs, which means micro, small, and medium enterprises. It's a fancy word for small businesses. As per the RBI regulations, banks have been mandated to offer MSME loans of up to 10 lakh without accepting collateral. Sometimes, depending on the financial position and track record of the MSME units, banks can increase this limit to 25 lakh. There is another set of loans called the Mudra loans. These loans are provided for income-generating small business activity in manufacturing, processing, service sector, or trading. The project cost is decided based on the business plan and the investment proposed. This loan is not for consumption or personal needs. There are 3 categories for the same: Shishu, up to 50,000, Kishore, above 50,000, and up to 5 lakh, and Tarun, above 5 lakh up to 10 lakh. In the financial year ended March 2023, over 4.5 lakh crore loans were disbursed, against 3.31 lakh crore in financial year 2022. These are some central government-centered loan schemes currently in place to make sure small businesses do not just survive, but thrive. So, we have learned about modern money and its connection to the banking system, emphasizing the crucial role of credit. Credit can have both positive and negative impacts, and it's available from formal and informal sources. Currently, wealthier households access formal credit, while the poor rely on informal sources. To foster development, formal sector credit must increase, and equitable distribution is essential. See you in the next video. Make sure to subscribe to never miss any update.